It's Sunday morning, so why not go on a rant? So I'm going to do a two-parter trying this. We'll see how it goes. Not legal advice. Uh, Even if you don't like this is my new motto. Even if you don't like the host or content, if you don't hate kids, like and subscribe. Um, for every 1,000 subscribers I get, $50 will be donated to the Los Angeles Children's Hospital. So go ahead and like and subscribe and share. Today, I'm going to do, as I said, a two-parter. The first one is related to Silicon Valley Bank, and you need to wait to the end to understand how this will relate to the second one, which will be more about FINRA. And that second video, the title of that will be "Regulators Suck." So look forward to that. But let me go through this a little bit because it'll kind of set the table for the second video. So we all know that Silicon Valley Bank failed and it's in Chapter 11 bankruptcy now. And it's been treated as a SIFI, and a SIFI is a systematic, important financial institution. It's if it's deemed a SIFI, it requires to have additional oversight and has stress tests, etc. It would cost the bank a lot more money, but we would be more assured of the viability of such an institution. In 2018, the law was changed in terms of the amount of assets that would be required to qualify as a SIFI. It went down. It went up, excuse me, to $250 billion. It had been as low as 50 or $100 billion, et cetera. Just for context, Silicon Valley Bank was just a little over $200 billion. So technically, it wouldn't have qualified under the revised 2018 law. But it doesn't have to be only banks. It could be any kind of financial institution. So, for example, MetLife at one point in time was designated a SIFI, and they sued in 2016 and were able to somehow convince a court that they weren't. So the benefit to them was they didn't have to go through the extra tests, cost, oversight, accounting, etc. So it's good for them, probably bad for us. Per a recent Treasury hearing I saw last week, where Janet Yellen was being questioned, um, there also is a way, if you don't qualify with $250 billion in assets, the Fed, FDIC can vote if there's a supermajority, and then the Treasury Secretary gets the president to sign off, then they can call you a SIFI. And apparently that's what they did with Silicon Valley Bank, because obviously it didn't qualify in terms of assets. It didn't get the stress tests. It didn't get the special oversight, but it got the special protection. So that there seems to be a problem in that scenario. I haven't quite figured that out, but there's a problem. About Silicon Valley Bank, 97.3% of all depositors were not insured. So that's going to be unlike most banks. Um, Again, it didn't, unfortunately, even though it got the treatment of a SIFI, it didn't get the tests and oversight that would be necessary. And since then, I heard Janet Yellen, indicate that only banks that qualify as SIFIs will be protected in full. The deposits will be protected in full. And that caused concern in the hearing, because the question is now, why would a community bank, or why would depositors who have more than, let's say, $250,000 in deposits, keep their money in a community bank, which is at risk, as opposed to moving it to JP Morgan or something like that? And on top of that, in funding the FDIC, all banks have to contribute to that. So even though, for example, community banks may not be getting the full benefit, they still have to pay the full premium to support the FDIC system. So again, something does not seem quite to fit there. And it seems to me that by making that public statement, and she appeared to, in my opinion, she was an inept in this hearing in total, but by making this statement, she's going to cause many community banks to fail or to be stressed. It'll result in more failures and the need for more capital, which will press inflation. It'll increase the Fed balance sheet, and in total, just will not be good for citizens of the country, investors, et cetera, et cetera. Obviously, Silicon Valley Bank had unusual customers. They had a lot of IPOs and startups. They also did a lot of transactions for founders and others, which is fine. But again, it ended up with a disproportionate amount of depositors who were not covered by FDIC insurance. And uh, Silicon Valley Bank, in return for lending money, those companies and startups to park their funds at Silicon Valley Bank. And in 2022, in particular, as the market for IPOs and the stock market tanked, those startups continued to use funds like it was going out of style, which deflated the amount of deposits that were at Silicon Valley Bank, which in effect helped create the problem. An additional problem was that 42 billion, I believe, was withdrawn in one single day, which may have been appropriate, although it was kind of exacerbated by calls by other venture capitalists to withdraw money. It may have been a prudent move, I don't know, um, but it certainly kind of exacerbated the run. And just to give a little context, in the largest ever failure of a financial institution or bank was Washington Mutual in 2008, and that had assets at that time over $300 billion. So it's significantly bigger than Silicon Valley Bank. Uh, and in that case, as opposed to $42 billion being withdrawn in one day, in that case, it was something on the order of 15 or $16 billion over 10 days. Um, that's what I recall. I may not be precise in those figures, so I'm not going to swear, but it's going to be pretty close. There's going to be a big difference in the total amounts, and Washington Mutual was spread out over a much longer period. So this run at Silicon Valley Bank happened much more quickly, and again, I think it was exacerbated by venture capitalists with whatever motivation, whether it be to protect their own funds or to potentially take over that particular asset class. We don't know. Uh, Obviously, one of the problems at Silicon Valley Bank, as we now see, is management was inept at best. And in terms of their investments in long term bonds, they were inept in not layering the bonds. So everything was due at the same date, at the same rate. And as interest rates went up, which was not their fault, that was more of the fault of the Fed, but they got stuck. But if they had layered their investments, they wouldn't have been in that position. I also wonder about why nobody went to the government privately before the collapse, because obviously this issue was known, and I'll get to that at the end. This issue was known. What didn't just happen in March? It was known. So if there had been contact with the Fed or Treasury earlier, perhaps this situation could have been avoided. The bank run could have been avoided. A deal could have been set up. So that concerns me. I don't understand why that. And I know that Goldman was trying to resolve this or apparently trying to resolve this for Silicon Valley Bank. And I don't know why they didn't handle it privately or why they weren't able to complete the capitalization of Silicon Valley Bank, which they were hired to do. And I know they did purchase securities from Silicon Valley Bank, at which they got a pretty good deal. And I know they sold bonds for Silicon Valley Bank, and this happened after the run. So it's kind of a little surprising they weren't able to capitalize the bank. I don't know if they have any vested interest in this particular asset class that has now been vacated because Silicon Valley Bank's not going to be loaning out to IPOs, et cetera. So that remains to be seen. But here's the punchline. So I kind of laid that out, and the my basic premise here is that, and you will see my next video, regulators suck. So, December 2022, there's a Seeking Alpha article that basically says the bank's in trouble. So, if Seeking Alpha knew that the bank was in trouble, how come the Fed, the FDIC, never looked at a balance sheet, never contacted the bank, didn't know what was going on? If Seeking Alpha knew this 3 months ago, 3 months before the collapse, where were the regulators? That's going to be the problem. Where are the regulators? Why aren't they doing their job? Why isn't Congress following up on the regulators? These are all issues that we need to press. So contact your congressman, contact whoever, post, tweet, send emails, let your friends know. Just be active, but don't accept this. This is unacceptable. The regulators are there to protect us, not to screw us. We expect them to be competent. We expect them to do their job. So do their job. Do their job. Take care. Look for part 2 later.